to Roth or not to Roth? That's the question we're talking about here today. And we're going to be talking about three main factors that drive wealth outcomes between your traditional IRA and 401k and your Roth IRA and 401k. Hi, I'm Garrett Ray, financial planner here at the Wealth Guardians and the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to compare IRAs versus Roths. We're going to talk about current versus future marginal tax rates. We'll talk about the impact that R&Ds have on both types of accounts and contribution limits and tax liabilities on IRAs and Roths. Once again, I'll bring your attention to those like and subscribe buttons down below the screen there. Go ahead and click on one of those if you want to be sure to catch all future episodes of The Vault with Doug, Garrett, and myself. And we'll go ahead and dive into this episode, Garrett. Yep. In one or two sentences, an IRA versus a Roth. An IRA is pre-tax money that grows tax deferred as long as you wait until 59 and a half to use the money.
Correct.
Whereas a Roth account is after-tax money that grows tax-free as long as you wait until 59 and a half to use it. There are both different types of retirement accounts that the IRS allows us to use. But the differences on the surface there are one thing, but then you can dive deep into it and go into more differences. I will state this. I have people ask me frequently, clients, what is better, Brice, an IRA or a Roth? Well, there is no better. One is more proper for a certain situation than another is. And really what it comes down to is what are the details of your specific situation to understand which one's going to be more beneficial for you. But there's not a good or this one's better than this one.
Yeah, it's more of just understanding the features between both, and that's really what we're going to touch on today. And so kind of getting into our first point as far as what are current marginal tax rates versus what are marginal tax rates likely to be in the future. If you look at it just kind of off the rip, essentially it comes down to this main strategic point in that the Roth may win or may be the better investment allocation or I guess classification if we believe that taxes are likely to be higher in the future when we have need of the money inside the account. So 10, 15, 20, 30 years down the road, are taxes likely to go up, or could you potentially find yourself in a higher tax bracket? You know, perhaps you've accumulated some wealth, you've got some other different investments, maybe some rental properties, that sort of thing, 20, 30 years down the road. And so you would like to have a source of tax-free money or a tax-free bucket of money. Right. That's when the Roth would really be beneficial. If we are of the belief that taxes are likely to remain the same or go down in the future, then you would basically lean more towards the traditional IRA, the traditional 401k. Go ahead and enjoy your tax break on the contribution now. And if you find yourself potentially in a lower tax bracket in retirement, perhaps you're working like a really high compensating job today, but you know that, when you're well into your retirement years, you're not going to have much in the way of income, then perhaps the traditional at that point would make more sense.
Yeah, it certainly all seems to make sense. Now, there is a little thing out there called RMDs. People who are of a certain age are very familiar with that term, and others out there who are maybe a little bit on the younger side, maybe they've heard it, but they don't know what required minimum distributions are. Go ahead and enlighten us as to what RMD is and what kind of impacts that law has on us all.
Absolutely. So there are one major distinction that we have to get out up front is a important distinction about the Roth IRA. Is that it does not have required minimum distributions on that account for the life of the account owner. Meaning that inside of a traditional IRA, once you hit the age of currently 73, and soon in a couple of years, it's going to go up to 75. But whether you want to or not, if you have need for the money or not, when you hit 73, the government's going to say, okay, you're inside of a traditional IRA or a traditional 401k, you have to start taking money out, which then adds another layer of income to your retirement and could potentially bump you up into an even higher tax bracket because that's income that you didn't have previous need for. Now you're suddenly forced to take it out, and that layered on top could bump you up into a higher tax bracket, so your effective tax rate could go up. The Roth, there is no such thing as required minimum distributions because guess what? You already paid all the taxes on your contributions when you made them 10, 20 years ago.
The whole reason that the government wants you to take an RMD or forces you to take an RMD on the IRA is because they want to collect their share of the taxes on it.
Right.
They're not getting anything from you when you take a distribution from a Roth, so they could care less in that sense.
Exactly. Now, it is interesting to note between the Roth and the traditional IRA, the Roth gets the benefit, I guess we'll call it, of not having required minimum distributions during the lifetime of the account owner. But beneficiaries are still required to take RMDs even on Roths. Now, granted, the taxes are treated differently. That's an RMD they have to take, but it's tax-free. But it is still something that account, when it's passed to a beneficiary, then it goes into its RMD schedule, just like a traditional IRA would. If it's a non-spousal beneficiary, meaning like a child or potentially a sibling, then you fall under the 10-year rule that Secure Act 2.0 put into place, where basically it says once you inherit the account, you have 10 years to clean the entire thing out.
Yeah, we're talking about IRAs and Roths here, not inherited IRAs or inherited Roths.
Correct.
So we'd have a whole different vault on those two things.
Exactly.
All right.
Yep.
Do we want to talk about contribution limits? Because you can't just throw an endless amount of money into an IRA or a Roth. There's some limits there. Talk to us about the limits.
Yeah. So for both, for a traditional IRA or a Roth, currently the limit, the maximum amount you can contribute if you're younger than 50 years old is $7,000, as we are filming this in 2025. If you are age 50 or older, you can contribute $1,000 more, so up to $8,000. Obviously, if we're talking about a married couple, you can have a his and hers account, and that's $16,000 for the entire couple. Or so you've got those different types of contribution limits. The one thing that is important to clarify, though, is that inside the traditional IRA, let's say you're making a contribution limit, or sorry, you're making a contribution. It's important to note that not all of that contribution is for you. Remember that a portion of that is going to Uncle Sam. So let's take an example here. Let's say that you have $1,000 inside of an IRA. It's relatively small, but you find yourself in the 22% tax bracket. Not all $1,000 in that traditional IRA is yours. You actually only have $780 in that IRA for yourself. The other $220 is for the IRS. So now let's fast forward a couple of years and let's say that IRA doubles. Okay, now you've got $2,000 in that account. Well, that's good. That's fantastic returns. You doubled your money. But remember, if you're still in that 22% tax bracket, your portion and Uncle Sam's portion are still the same. So now you only have $1,560 in that account for yourself. The IRS now has $440. So they're growing in equal proportions of what your tax bracket is. Here's where that can become an issue. If you have a person who's motivated to invest and kind of think for their future, suppose we run into the person that really wants to maximize and hit that upper limit, that upper threshold of $7,000 a year towards their contribution. If they make that $7,000 contribution per year in a traditional IRA, guess what? Not all of that $7,000 is going to them, right? Remember, there's still Uncle Sam's portion. So if they make that contribution of $7,000 inside of a traditional IRA, then $5,460 is for them, and $1,540 is actually for Uncle Sam. Now enter the Roth IRA. If you make that $7,000 contribution, all $7,000 are going to you. So to me, that's where the Roth really wins most, is that if you are of the mindset that you really want to completely maximize your contributions, then more of your money is actually going for your benefit than in the traditional account.
Yeah, IRA stands for Individual Retirement Arrangement, or account, but it's technically arrangement. There's no bigger misnomer out there in the financial and the retirement world than that acronym, IRA. Individual, it is not an individual account. Uncle Sam's money is in there with yours. I have found so often, Garrett, that people cringe when having to take money out of an IRA because they've told themselves, oh, I own $1 million. There's $1 million sitting in my IRA. hence I own $1 million.
Yeah.
And that's not true. It was always from the very beginning designed that a portion of that money was Uncle Sam's.
Correct.
So when it comes time to take a distribution, if you have trained your mind to see, oh, I don't see $1 million there, I see roughly $800,000 there, then when you take a distribution and you give Uncle Sam his share, it doesn't sting as bad because you've already trained your mind to realize that you're giving Uncle Sam his money, not your money.
Exactly. That's right.
I would love it if more people understood that.
Well, and Brice, we're talking about IRAs and Roths as an example, but also your traditional versus Roth 401k, same thing. Same
exact thing. Yep. Yes, exactly. All right, let's go ahead and talk about contribution limits. Well, we talked about contribution limits. Is there anything else as far as tax liability that we want to talk about?
No, really, it was more just understanding that the difference between the traditional contribution and the Roth contribution, that even though you feel like you're making that contribution towards your account, quote unquote, inside the traditional, just understand that a portion of that contribution is always Uncle Sam's from the start. And that's really what I wanted to highlight. If you're of the mindset that you want to maximize your contribution right up to the limit, and you want the most dollars to go to work for you and not necessarily the IRS, then perhaps the Roth might be the right call.
Yeah, I sense that there's a lot of people out there watching this vault who, now that we're coming to a close on this, they're thinking, well, doggone it, I watched this whole video wanting to understand which one was best for me. And the answer that we always give is it depends. There's a lot of calculations that go into this. And maybe somebody's thinking, should I do an IRA to Roth conversion? You want to have a proper balance of both in your retirement accounts. You don't want to have all IRA. You don't want to have all Roth. There's imbalance there. What that balance is, either percentage-wise or dollar amount-wise, is going to be different for everybody based on what other kinds of accounts you have, what your spending needs are.
What tax bracket you're in.
What tax bracket you're in. Do you have other forms of income coming in? For one couple, it might be that your IRA bucket needs to be filled up to here, and everything else above that would be Roth money. And for another couple, it'll be down here. And when you contribute, what years you contribute to an IRA versus what years you contribute to a Roth, you can forecast that out if you've got a good financial planner on your side. But if you're just trying to do it on your own, it does get complicated. But I'm sorry we don't have that universal answer for you that here's that magic number of what you want to have in an IRA, and here's the magic number that you want to have in a Roth, or that we were going to badmouth one or the other. That's just, there's no universal answer, I'm sorry to say.
That is true.
All right. Well, thank you, Garrett. That's going to wrap it up for this episode of The Vault. Again, like and subscribe buttons hanging out right down there, waiting for you to click on them. Go ahead and hit one of those so you can catch all future episodes of The Vault with Doug Garrett and myself. As for this episode, I'm Brice Payne.
And I'm Garrett Ray.
And this has been The Vault. Hey, it's Brice Payne with the Wealth Guardians. Thanks for watching our weekly series, The Vault. Do you know we also have a weekly radio show where we discuss all things retirement? You can listen to the Wealth Guardians radio show live on 94.5 WPTI in the Triad on Saturday mornings. But if you missed the live broadcast, you can also catch it on our YouTube channel or find us on your favorite podcast platform each Saturday morning. Make sure to subscribe wherever you listen so you can get notifications when we release new episodes. I want you to remember, good retirement plans do not create themselves. We'll talk to you soon.